Welcome back to the deep dive. We're here to, cut through the noise and really get into the important stuff together. Today we're tackling something pretty critical, affects almost everyone, but maybe it doesn't get talked about enough. How our employers, our workplaces are stepping up with personal financial help. You know that feeling, right? That financial stress. Could be student loans just grinding you down, or maybe a sudden car repair that throws everything off, or just making ends meet. It messes with your focus, your sleep, everything. But what if, just what if, your company actually had some real solutions, some actual benefits to ease that pressure? That's exactly what we're going to unpack. This deep dive is all about getting you the info you need on these, financial lifelines employers are starting to offer.
Yeah. And what's really
Yeah.
striking is how employers are catching on. They're seeing that money stress isn't just a you problem. It hits productivity, morale, whether people stick around. It's a real shift, moving away from your finances or your businesses to companies actually playing a supportive part. So our mission here really is to pull out the key things you need to know about these different loan programs, the debt help your employer might have. You could be surprised.
Totally. And for so many people, the big one, the elephant in the room, is student debt. Feels like this huge mountain sometimes. But employers are starting to offer some serious help here. We're talking student loan repayment assistance. It's becoming a really popular benefit. And here's why it's such a big deal right now. Pay attention to this bit. There's a tax rule. Allows employers to give you up to $5,250 a year for your student loans. And the key part, that money is totally tax-free for you, the employee. That's huge. This rule is good through at least the end of 2025, so it's a real window. How it usually works is through something called an Educational Assistance Program, an EAP. Think of it like a company program for education costs, but now it covers student loan payments too. So maybe your company sends, $100 a month straight to your loan company, or they give it to you to make the payment. Either way, up to that $5,250 a year, you don't pay income tax on it. It's like getting extra pay, but it goes straight to debt and no tax it. That's massive.
It really is. And if you connect that to the bigger financial picture, like retirement savings, it gets even more powerful. There's this legislation, the Secure 2.0 Act. It did something pretty clever. It lets employers count your student loan payments as if they were 401k contributions, just for the matching part. That's a real light bulb moment for a lot of folks. Think about it. Maybe you're hammering away at those student loans, right? So you can't put much into your 401k. Well, now you don't automatically lose out on the company match. Your employer can match your student loan payments kind of like they were going into your retirement account.
Wow. Okay. So you don't have to choose between debt and retirement savings.
Exactly. You can sort of attack both at once.
Yeah.
It speeds up paying off the loan, saves a ton on interest, cuts down stress. And for companies, it's a great way to get and keep good people. I saw one survey, something like 70% of employees said they'd be more likely to stay if their company offered this, happier too. So yeah, if you have student loans, you absolutely need to see if this is something your employer does.
That's a huge shift, getting out of debt and saving for the future at the same time.
Hmm.
Okay, so beyond the tax stuff, what's maybe a common misunderstanding about this?
Well, one thing is people sometimes think the money just lands in their paychecks, like regular salary, to use however. And while some might do that, usually the most tax-smart way is for the employer to pay the loan servicer directly. Keeps that tax-free status clean. Also, maybe thinking it's just a small amount, but $5,000 tax-free every year. That can seriously cut down your repayment time. Saves thousands in interest. It's definitely not small change.
Good clarification. Okay, so that helps with the long-term debt game. But what about, life happens, sudden emergencies, needing cash now? Some employers are stepping in there too with more immediate help. Yeah, this part's really interesting. These things called emergency or hardship employee loans, these aren't like bank loans. They're for those sudden, unexpected things, surprise medical bill, car breaks down, need help with rent this month. And the best part, often they're interest-free. Or maybe super low interest, way, way better than sticking it on a credit card or, God forbid, getting a payday loan. Plus, repayment, super easy, usually just comes out of your paycheck bit by bit. Right, I've seen examples like loans up to maybe $5,000, sometimes even $10,000, paid back over a year maybe. And here's a key detail for you listening. If it's set up right, clear agreement on paying it back, that loan money usually isn't counted as taxable income for you. Plus, there's this rule. For loans under about $10,000, employers can offer them at 0% interest without causing tax headaches. Otherwise, the IRS might say that interest you didn't pay is like a taxable benefit. But that $10K threshold usually avoids that whole issue.
Yeah, it's a real lifesaver, that kind of setup. Gives you breathing room without digging a deeper hole with high interest. You see bigger companies sometimes partnering with nonprofits or credit unions for this.
Yeah.
Like federal employees have FEE, the Federal Employee Education and Assistance Fund, for no-interest emergency loans, shows companies are seeing this need.
Definitely. It's about addressing that immediate vulnerability.
And building on that idea of immediate help, we should also talk about pay advances, or the term you hear more now is earned wage access, EWA. It's really important to get this. It's not actually a loan, not in the traditional sense. The eye-opener with EWA is you're accessing money you've already earned before your regular payday hits, and crucially, zero interest.
Okay, so how does that work in practice?
Right, so imagine it's, say, Wednesday. Payday's Friday. You've already worked enough hours this week to have earned, let's say, $800. But, whoops, unexpected expense just came up. With EWA, you could maybe request, like, $200 of that money you've already earned right now. Services like Daily Pay, Earnin. Sometimes companies have their own apps for this. And that $200 you access is usually free. The employer might cover a small fee, or maybe there's a tiny transaction cost. Then it just comes out of your upcoming paycheck. Simple.
Ah, okay. So it helps avoid things like overdraft fees or late charges.
Exactly. Or needing a high-cost payday loan. For people managing tight budgets paycheck to paycheck, this gives them, flexibility, more control over their cash flow when they need it. And employers, they love it too. Helps keep people happy, reduces turnover. I heard about one PEO, those companies that handle HR for other businesses. Their clients saw turnover drop by like up to 29% with on-demand pay. Help them hire faster too. But, and this is important, you got to use it responsibly.
Right, like not relying on it every single week.
Precisely. If you keep taking advances, you might end up short on your actual payday, which kind of defeats the purpose. But use for those occasional bumps. It's a fantastic tool. Puts control back in your hands.
Those immediate options, wow, they really could change how people manage everyday money stress. Stop small problems from snowballing. But it doesn't stop there, right? Some companies are finding other pretty creative ways to help out financially.
Yeah, we're seeing other things too, like relocation help. If you move for a job, bigger companies often give loans or advances for that. Sometimes those are even forgiven if you stay for a couple of years. Then there's help buying a house, maybe down payment assistance, or working with banks for better mortgage rates for employees. I even remember reading about tech companies way back offering zero-interest loans for computers, paid back through payroll, helping people get set up at home. Oh yeah, those computer loans were a thing. And don't forget, partnerships with local credit unions. Sometimes employers set that up so employees get better access to loans generally. And though it's not technically a loan, those qualified disaster relief payments are critical. Tax-free grants from the company if you're hit by a hurricane or fire. Huge help without adding debt. It all shows this wider commitment.
It really paints a picture of broader support.
And speaking of accessing funds, we probably should touch on 401k loans. Still an option lots of plans offer. It's kind of unique because you're borrowing your own retirement money, usually up to half your vested balance or $50,000, whichever is less. And you pay yourself back with interest into your own account.
So it sounds straightforward, using your own money.
Well, yes and no. First, the employer's plan has to allow it. It's not automatic just because you have a 401k.
Yeah.
But the bigger thing is the risk. There are significant downsides you really need to think about. The main one, if you leave your job, quit, get laid off, whatever that loan usually has to be paid back really fast, like sometimes in 60 or 90 days. If you can't cough up the cash, the whole remaining loan balance gets treated like you took it out as cash. So income tax on it, plus probably a 10% penalty if you're under 59 and a half.
Ouch. That could be a nasty surprise.
Big time. A surprise tax bill and you've hurt your retirement savings. Plus, even while you're paying it back, that money isn't invested, it's not growing. That's the opportunity cost. So yeah, it's an option, but definitely one to weigh very carefully, maybe more like a last resort.
Okay, that's a really thorough look at the different ways employers are stepping in. It definitely feels like the whole landscape is changing. So wrapping this up, what's the big takeaway for everyone listening? I mean, the theme seems pretty clear, right? Companies are getting it. They're prioritizing financial wellness more, realizing that if you're less stressed about money, you're probably, well, a better employee, happier, more focused, more likely to stay. And checking out these benefits, it's so worth it. Seriously, using a student loan match or maybe an interest-free emergency loan, that can shave years off your debt, save you thousands, reduce so much stress. So the call to action is pretty simple. Find out what your employer offers. Check the handbook, look at the benefits website, maybe just ask HR or someone you trust. You might be leaving valuable help on the table without even knowing it.
Absolutely. And one more thought on that. Even if there isn't some big formal program advertised, it never hurts to have a quiet word with HR. They might have smaller ways to help, like a small advance, or they could point you towards other resources. It just reinforces that idea. Managing debt, financial stability. It's not just on you anymore. Your employer often wants to help you succeed financially. It's good for you, good for them. So thinking about this whole trend, employers getting more directly involved in our financial lives, what could that mean for work-life balance down the road? And maybe how can you use this knowledge to, advocate for better financial support where you work? Something to think about.